All right, thank you everybody for joining us today. My name is Marty Platchko, and I am a partner and head of distribution with Impact Consulting and Distribution. We are a third-party marketing firm that represents a number of high-quality, unique investment managers, one of those being Global Beta Advisors, and we're thrilled to have Justin Lowry with us today, President and CIO of Global Beta Advisors. Justin, thank you for being with us today.
Hey, Marty, thanks for having us.
Absolutely. And today we're going to talk about generating income in a low rate environment. Income sometimes seems to be elusive when it comes to portfolio construction, yet something that most investors strive to achieve. So I'd love to kick it off just by hearing your thoughts along what are you seeing across the income landscape today?
Yeah, so, it's no secret right now, and it's been the case for many years at this point, particularly coming out of the financial crisis, just kind of the landscape of a low yield environment. And, it's been a struggle for investors to find a high quality way to find a strong yield without compromising, actually getting yield. And so what we've seen is, particularly recently with the recent COVID-19 related economic recession, of course, we've got the 10-year Treasury yield that's been below 1% since the market bottomed on March 23rd. In our view, we believe that kind of given the tone of the Federal Reserve, that 10-year yield is likely to stay at or below that 1% threshold for a protracted period of time. So what do investors do? Of course, you kind of go along the spectrum of risk to try to find that yield. You can go through corporate bonds, you can go to more high yield, junk rated type of bonds, and then you get to equities. In our view, we believe the greatest risk return is better in equities in terms of finding yield and total return in general. And that has to do, of course, with the overwhelming source of liquidity that's being provided by the Fed, and consequently keeping those bond yields suppressed at these levels.
That's great. I appreciate those comments. Do you have any thoughts on quality versus quality versus high yield income strategies, as well as the sectors that may be represented within those?
Yeah, so and that's kind of how we view dividend-oriented strategies in the equity environment. You either see investment managers build strategies conducive to quality-oriented income, where you have investment managers trying to build portfolios that seek the highest possible yield out there. And for us, we're trying to thread the needle between quality and high yield. And so when you look at quality, they're generally looking to get slightly above broad market yield. So the S&P 500 is a little bit below 2% in terms of a dividend yield. So these quality-oriented dividend strategies try to target in the range of 2.5% yield, which is certainly more than the market, but it's not substantially more than the market to justify the fact that it's a higher yield strategy than just simply investing in the market. So these quality-oriented dividend strategies typically look at the balance sheet of a company and kind of use that as a quality screen for inclusion in their indexes. And what happens is they generally lead to larger cap stocks that are in healthcare, technology, and industrials, and really kind of lend, like I said, to more fortress balance sheet oriented companies. And sometimes in doing that, it leaves a little bit out there in terms of yield. And then when you go to the other end of the spectrum, in terms of high yield oriented strategies, as I mentioned, those strategies specifically target higher yield type of investment instruments, if you will. And with that, a lot of the times you kind of get junky oriented type of investments, and that lends to master limited partnerships, i.e. MLPs, or real estate investment trusts, i.e. Reits. MLPs are generally attractive just because of the structure of the limited partnership, which allows the entity to not be taxed at the corporate level. It's taxed at the individual limited partner level. So that's very attractive for people looking to get a steady income stream. But the problem with MLPs becomes that they become highly inefficient in terms of liquidity. So there's a lot of price discovery disconnect from the intrinsic value of the MLP and from where it's being priced in the market. And the other part is sometimes with MLPs, they generate some of the income that they do generate that they're then returning to shareholders may be non-business related income, which may not qualify within the structure of MLPs. And a lot of those factors are reasons why some investment vehicles don't even allow the inclusion of MLPs. In terms of REITs, REITs are a good way to obviously get exposure to the real estate market. There's a little bit more liquidity there. The problem with that is then you then have exposure to interest rate risk, right? And so that becomes a little bit problematic when you've got that kind of macro influence in terms of the investment style that you're in. Lastly, a lot of the times people look at utilities and communication services being really kind of the former telecom sector. Those two sectors in terms of valuations have gone up substantially over the past 10 years as people try to look for income, and it's kind of created this artificial bubbling in those two sectors. In fact, based on price to sales over the past 10 years, those two sectors have had the greatest increase compared to the other 9 sectors, the other 9 GICS related sectors. And so because of that valuation premium, that gives us a little cause for concern when you're looking for yield at the right price.
Sure. And what is Global Beta's approach to achieving yield while managing the risk of typical high yield dividend securities, and how might that be different than other investment managers in the marketplace today?
Right. So, we went over the two kind of different styles in terms of dividend-oriented strategies. And when we touched on the quality part of or the quality version of the strategy, we talked about how that generally gravitates towards more established large cap oriented companies. So for us, we researched this and we found that there's just as many mid cap companies that have strong dividends as large cap companies. So for us, when we created our strategy, we started with a composite of large cap and mid cap securities. So we use the S&P 900 index, which is that composite. So that starting basis allows us to introduce a little bit more size into the investment portfolio universe. And so what we do there is we're looking at 12-month trailing dividend yield, but not just from the most recent reported quarter. We're looking at it from each of the previous 4 quarters. So it almost gives us a 2-year running average for each company to give us some level of indication of the consistency in which that yield is as strong as we're seeing it. And then what we're doing is we're analyzing the yield over each of the 11 GICS sectors. So we're trying to include equal parts across the spectrum of industries within our index universe. And then finally, once we get our final index universe, we're using revenue to weight the portfolio. So, we talked about MLPs a little bit before. One of the reasons they're able to generate income, at least, income in terms of GAAP GAAP accounting, is that they've got significant depreciation costs. And so it kind of manufactures a yield that, may be higher than it otherwise would have been. Whereas when we revenue weight this portfolio, we know that we have companies with sustainable top line revenue to support dividends hitting the bottom line. So, and what it also does, of course, is it reduces the valuation, the overall valuation of the portfolio. So, that's kind of how we view the world here, is creating a portfolio that's dynamic and balanced. Also reduces kind of the valuation risk that is introduced by sectors like utilities and communication services that have been bid up by investors looking for yield. The other component that we have in our strategy is we cap the exposure to energy at 3% when the oil futures are below its 30-day moving average. Now, of course, energy, for the most part, energy securities are dependent on the price of oil for profitability. When oil is higher, they can create more profitability. So when we look at the oil futures market and we determine that it's trading below what it has been trading for the past 30 days, we know that that kind of view of profitability diminishes for the energy sector. So that's why we employ the cap. And so when in the next rebalance, if the oil futures are above its 30-day average, then that gives us the indication to relieve that cap and allow energy to kind of float above that 3% cap mentioned before. And then the last component is we're looking at any companies that cut their dividends. Any companies that cut their dividends are automatically excluded from the inclusion of the portfolio universe. And what that does is it allows us to avoid higher risk yield, if you will. So for example, if we're looking at a Chevron or an Exxon cutting their dividend and they go from a 10% yield to a 7% yield, well, 7% yield is still quite high, and would probably qualify for the portfolio. But because it cut its dividend, we view that dividend as not as sustainable, and so we're going to remove it from the from consideration until it shows enough balance sheet power to then raise the dividend, and then we'll consider it back in that following rebalance.
I like that. So it's fair to say you offer factor exposure to dividends with lower valuations and possibly holding the stronger balance sheet companies within the portfolio.
That's right. So, and that's our ultimate goal is we want to look at the fundamentals of these companies to really see that. And we think that, revenue is a great indication of a company that can, manufacture stronger cash flows. And the consideration around companies that cut their dividend also creates that quality check around the strength of the most recent strength of the balance sheet.
And I'm curious, just from a sector perspective, what sectors you might be overweight or underweight today?
Yeah, so in particular, we're in this strategy here, the global beta smart income strategy. We are currently overweight the financial sector, and the financial sector has been beaten up pretty badly. And amazingly, there's been very few financial companies that have cut their dividend, even in the wake of all of the lending that's going on out there, and the potential risk for defaults. So, Wells Fargo, off the top of my head, is really kind of the only notable financials company that's had to meaningfully cut their dividend. And of course, that company is not included in consideration for our portfolio because of that reason. But other than that, the financial sector has kind of been indiscriminately beaten up. And so as a result, we've kind of been able to pick up a lot of those pieces, and we look at it and see, well, there's a lot of strength around those companies to continue to sustain their dividends. They're high revenue companies. They're still finding ways, whether it's their investment banking, trading activities, they're finding ways to continue to generate enough income to sustain those dividends, even in the wake of this uncertainty around loans.
And I know we've seen since the election, these financial stocks have performed quite well.
Absolutely. And again, we just think it's one of those things where it's easy to sell things out of panic and headline risk. But when you look at the financials, when you look at the numbers, it's really a situation where it's kind of unfound to continue to put pressure on these stocks, because there is really some strong value to be found. And look, they are dividend paying stocks. They are strong yield stocks, and their balance sheets are better than they were before the financial crisis because of all the regulations that have been put into place. So I think people tend to forget some of the power the banks actually have had going back, coming out of the financial crisis. And that's created a situation where they've been able to sustain this economic recession and continue to pay dividends and provide strong value in the marketplace.
Yeah, it sounds like you all have your pulse on the opportunity. Changing gears just slightly, any thoughts on holding dividend paying equities along with bonds within the portfolio, and how you might optimally combine those moving forward?
Yeah, so we opened the discussion here around the fact that bond yields are very suppressed because obviously the recession, and the Fed's echoing of continuing to keep rates low and provide additional monetary support. However, we do believe that the recovery is going to bring yields up a little bit higher. So there is definitely a spot for bonds in the portfolio. Our belief is, as I mentioned, the risk return on equities is stronger than bonds, but we do believe that there's a pairing effect that should go along with equities and bonds. So you can create kind of a weighted average yield between what you're owning in equities and what you're owning in bonds. And what we do is we actually build asset allocation models to show you the risk trade-offs between yield and volatility. So we do create those portfolio allocations, and we'd be happy to show people who are interested in those kind of models what that would look like.
Great. Well, I appreciate your comments today. Some great market intelligence and education. I know the viewers will appreciate it as well. Just as a follow-up, if anybody is looking for more information, you can visit globalbetaadvisors.com, or you can visit the Impact Consulting and Distribution website at impact-cd.com. We have built a learning center for Global Beta Advisors on our website with a lot more information. And of course, you could always reach out to myself and or Justin for further information and discussion. Justin, really appreciate your time today, and we look forward to seeing you next time.
Thanks, Marty. Appreciate it.
Likewise, Justin. Thank you.